At Millen Capital, we've been helping professionals, lawyers and accountants in particular, with their personal financial planning for 30 plus years, and there are definitely some common issues we see when we first meet new professional clients. I'm going to give you a quick, jargon-free rundown of the 6 most common blunders and our suggestions to avoid or rectify them. This stuff matters because pensions are the #1 tax-efficient way to save for retirement, and let's face it, we all want to retire one day. Number 1, missing the pension boat when becoming partner. We see this all the time, and we get it. Life is busy, and never more so when you're newly promoted to partner. What sometimes gets forgotten is that this new self-employed status generally means that you're no longer able to contribute to your employer pension scheme. So, unless you make pension arrangements privately, you can then miss out on valuable years of making pension contributions. This sort out my own pension task is invariably at the bottom of your personal to-do list, and so months and then years pass without a penny being paid into your pension. With tax relief of up to 45% on contributions for additional rate taxpayers, this is a big missed opportunity, and setting up a personal pension is actually really easy to do. Number 2, blasting through the annual allowance threshold. You may be aware that high earnings can limit the amount you're able to pay into your pension each year. If you're earning over £200,000, it's likely that the amount you can pay into your pension each year, normally £40,000, will taper right down to just a £4,000 a year allowance if you're fortunate enough to be earning over £312,000. Sometimes there's a window to maximise contributions before the taper begins to apply, and we frequently help clients to make carry-forward contributions where you can use unused allowance from the previous 3 years to do a decent pension catch-up. If it's too late for that and the taper has scuppered your ability to save much into a pension, then the next go-to retirement investment pot is ISAs, where you can make a £20,000 annual contribution for you and another £20,000 for your partner if you have one. To be honest, you should be filling your ISA subscription each year anyway. Number 3, sail through the pension lifetime allowance. A less common problem, and arguably a bit of a nice problem to have. The pension lifetime allowance is currently just over £1 million, and if you've managed to get your pension pot to this size, congratulations. The sting in the tail is that the excess above the allowance is taxed at either 55% if you take it as a lump sum, or 25% if you take it any other way when you trigger a crystallisation event in retirement. We work with our clients to monitor pension contributions and growth to avoid this where possible and switch retirement savings into other pots like ISAs. Number 4, losing track of old pensions. A professional will likely move firms several times in their career, and it's not unusual for us to meet clients who have perhaps 4 or more old employer pensions kicking around that they may or may not have the paperwork for. You can start to track down old pensions via the government website. Whilst these pots may not be huge, they can all add up to a healthy overall retirement pot. We can take a close look at your old pension details, and if it's the right thing to do, we can consolidate these pensions into one, giving a much clearer overall picture and, crucially, control of the investment approach. Number 5, not investing in a pension due to fear of independence rules. If you work for one of the big auditor firms, this will probably concern you. You rightly have to ensure investments are fully compliant with your firm's independence requirements. This is simpler than it sounds, and a good wealth management firm, like us, will be able to help you screen investments against your firm's requirements, allowing you to invest safely without fear of breaching any rules. We achieve this through investing our clients' money in globally diversified, low-cost index tracking portfolios, which is the smarter way to invest anyway. Number 6, head firmly in the sand when it comes to the future. Last but definitely not least, often, whilst we find professionals are generally making some regular contributions towards their retirement, they have given it very little thought beyond that. Most people have no idea exactly how much they'll have saved for retirement, and critically, whether it's enough to do all the things they want to do. Getting a grip on someone's total financial footprint and showing them through some really cool cash flow forecasting whether they're on track or how they can get there is a really rewarding part of our job as financial planners. Please get in touch via the contact details at the end of this film if you'd like our help. We will help answer the big question: when you retire, will you have enough?